There is a document that was passed across a table in Washington this month that almost no one outside of 7 banks and a handful of crypto lawyers has read in full. It is 4 pages long. It contains one word that was not supposed to be there. And the moment that word appeared on paper, the entire balance of power in American digital asset policy quietly shifted, without a single headline noticing. I am going to walk you through what that word is, why it was written, who allowed it to be written, and what it tells us about a fight that the banking lobby believes they are winning, but have in fact already begun to lose. Because the people who study these documents for a living, the lawyers, the policy architects, the institutional desks positioning behind the scenes, they all saw the same thing this week. And what they saw is not what the financial press is reporting. The mainstream story is that banks and crypto met at the White House, that there was tension, that a deadline was set. That is the surface. The real story is structural. The real story is that a wall the banking industry has been defending for 2 years just developed its first visible crack. And the way that crack appeared? Quietly, in subordinate clause, buried in paragraph 2 of a confidential proposal, tells you everything about where this ends. Pull back from the noise for a moment. Forget the politics. Forget the personalities. Look only at the architecture of what is being negotiated, and you will see something that the headlines are not equipped to see. This fight is no longer about whether digital assets win in America. It is about the terms of the surrender being drafted by the institutions that lost. Welcome back. I am the calm analyst. Today we decode the White House stablecoin negotiations, not the press conference version, the institutional version. We examine the document banks brought to the table, the language they did not intend to concede, the timeline the administration has locked in, and what every piece of this means for XRP and for the broader regulatory unlock that has been waiting in the wings for years. This is not financial advice. This is structural analysis. Let's get into it. That is the word that appeared in paragraph 2 of the document the banking coalition handed to the White House. Goldman Sachs, JP Morgan, Bank of America, Wells Fargo, Citi, PNC, US Bank. Plus the 3 lobbying arms that speak on their behalf: the Bank Policy Institute, the American Bankers Association, the Independent Community Bankers of America. The full architecture of American traditional finance, aligned on a single proposal titled Yield and Interest Prohibition Principles. And in that proposal, written by lawyers who have spent 2 years insisting that no exemption to a stablecoin yield ban could ever be permitted, the phrase, "any proposed exemption," appears. To understand why that single phrase is a structural earthquake, you need to understand something most retail investors are not being told about how regulatory negotiations actually work in Washington. Lobbying documents are not press releases. They are not opening offers. They are not theater. When a coalition of 7 of the largest financial institutions in the United States submits a written proposal to the executive branch, every word in that document has been pre-cleared by general counsel, by government affairs, by senior leadership. Nothing in it is accidental. Nothing in it is exploratory. So when the language shifts from absolute prohibition to any proposed exemption, that is not a slip. That is a coordinated decision by the banking lobby that they will not be able to hold the line they have been publicly defending. They are pre-positioning for a compromise they have already accepted internally, even as their spokespeople continue to insist publicly that no compromise is acceptable. This is what institutional capitulation looks like in real time. It does not look like a press release. It looks like a subordinate clause. And here is what makes this moment different from every previous round of this fight. For 2 years, the banking position has been that yield on stablecoins is an existential threat to the deposit base of American banking. that any exception undermines the entire regulatory framework, that there can be no middle ground. That position is now, in writing, no longer the position. The wall is cracked. The negotiation has moved from whether to how much. This is the hidden mechanism the headlines missed. The fight is no longer ideological. It is now technical. And technical fights are always won by the side with better infrastructure, better lawyers, and better positioning, which, in this room, was not the banks. Let's do the math that the banking lobby is hoping nobody runs. The American stablecoin market currently sits at roughly $190 billion in total circulating supply. Of that, the two dominant issuers, Tether and Circle, account for the overwhelming majority. The annualized yield those issuers generate from holding treasury bills on the reserves backing those stablecoins is, at current short-term rates, approximately 4 to 5%. Run the calculation. $190 billion multiplied by 4.5% is roughly $8.5 billion per year in yield generated by stablecoin reserves alone. That money currently flows to the issuers. The banking lobby's proposal would ensure that this money never flows to the holders of those stablecoins, meaning to you. Now scale the question forward. Conservative projections from Standard Chartered, Citi, and Bernstein place the stablecoin market at between $2 trillion and $3.7 trillion by 2028. Take the midpoint. $2.5 trillion in stablecoin supply, at even a reduced 3% yield environment, produces $75 billion per year in reserve-generated income. The fight you are watching is not a fight about consumer protection. It is a fight about who controls a $75 billion annual revenue stream that is going to exist whether banks like it or not. This is the math that retail does not run. The banks are not defending Main Street. They are defending a quarterly earnings line item that, if they lose this fight, transfers from their balance sheets to crypto-native platforms within the next 36 months. And here is where XRP enters the equation, because the math gets even more interesting when you layer in cross-border settlement. The current annual volume of global cross-border payments sits at approximately $150 trillion. The portion of that volume currently captured by SWIFT correspondent banking and the locked nostro-vostro liquidity model that supports it is roughly $27 trillion held in pre-funded accounts at any given moment. Capital that is, by definition, dead capital. It earns nothing. It moves nothing. It exists solely to make the legacy system function. If even 5% of that locked capital migrates to on-demand liquidity rails, which is the entire architectural thesis behind XRP's design, you are talking about $1.35 trillion in capital efficiency unlocked. At a fixed circulating supply of approximately 55 to 57 billion XRP, the velocity required to settle that volume at current price levels is mathematically impossible. The token must reprice, not as a prediction, as a requirement of the equation. This is not speculation. This is the logical outcome of the variables involved. If you have a problem with these numbers, the problem is not with the analysis. The problem is with the arithmetic. Now look at who is actually moving while the public is watching the negotiation. Ripple sent Stuart Alderati, their chief legal officer, into that White House meeting. He walked out and publicly stated that compromise is in the air. That language is not casual. When a chief legal officer of a regulated financial infrastructure company makes a public statement after a closed-door negotiation, every word has been weighed. Compromise is in the air is the institutional equivalent of saying, we saw the crack and we know what comes next. Brad Garlinghouse has placed his confidence in the Clarity Act passing by the end of April at 75%. That is a specific, falsifiable number from a CEO who is hearing things from people who were in rooms he was not. CEOs do not assign probabilities lightly. They assign probabilities when they have triangulated multiple sources and are willing to be measured against the outcome. Patrick White, the administration's lead on digital asset policy, has publicly committed to closing this negotiation. Public commitments from executive branch officials function as institutional collateral. They cannot be quietly walked back without political cost. Now zoom out from the negotiation itself. Look at what the largest asset managers in the world have been doing while this fight has been unfolding. BlackRock, Fidelity, Franklin Templeton, each one has either filed for or expanded their digital asset infrastructure in the last 12 months. BlackRock's tokenized money market fund has crossed multi-billion in assets under management. Franklin Templeton runs settlement on public blockchain infrastructure. These are not experiments. These are production systems being scaled by trillion-dollar firms. Ask yourself, does a firm like BlackRock allocate engineering resources, legal review, and compliance infrastructure to a market they expect to lose? They do not. They allocate to markets they have already concluded will win. The legislative fight you are watching is, from their perspective, a timing question, not a directional one. Meanwhile, the on-chain data continues to tell its own story. Exchange reserves for XRP have continued to trend toward multi-year lows. Coins are migrating into institutional custody at a pace that does not reverse. Once a token enters a multi-signature custodial vault held by a regulated entity, it does not return to market for a short-term profit. It is positioned. It is held. It is gone from the float. That is what the institutional desks are doing. They are not waiting for the Clarity Act to pass. They are positioning so that when it passes, they are already inside the trade. The retail crowd is watching the negotiation. The institutional crowd is watching the inventory. Mark these dates on your calendar, because the next 4 months contain more structural inflection points than the previous 4 years combined. March 1st. The White House has set this as the hard deadline for the stablecoin yield negotiation to reach a compromise. Whatever language emerges by that date becomes the foundation for the Senate version of the Clarity Act. Whether the compromise includes narrow exemptions, capped yield structures, or registration frameworks, the outcome on March 1st defines the regulatory shape of the American stablecoin market for the next decade. Late March to early April. Senate Banking Committee markup of the revised Clarity Act. This is where the technical language gets finalized. Definitions of digital commodities, jurisdictional lines between the SEC and CFTC, treatment of secondary market transactions. Every one of these definitions matters enormously for XRP, because XRP's classification under a clear statutory framework is the final piece of regulatory certainty institutional capital has been waiting for. End of April. The window Brad Garlinghouse has identified for a floor vote on the Clarity Act. If the vote happens on his timeline and the bill passes, the United States will, for the first time, have a coherent federal framework for the classification, custody, and trading of digital assets. Following passage. A cascade of pre-positioned institutional actions, spot ETF expansions beyond the current Bitcoin and Ethereum products, tokenized real-world asset platforms launching at scale, custody banks formally onboarding digital asset desks. The infrastructure that has been built in the shadows for the last 3 years activates in the light. Each of these catalysts is independent. Each one creates its own market reaction. Stacked together within a 4-month window, they represent the single largest concentration of structural catalysts in the history of American digital asset markets. This is not a thesis about a single event. It is a thesis about a sequence, and the sequence has already begun. Here is what the math tells you about the window you are currently inside. There are approximately 55 to 57 billion XRP in circulating supply. A significant portion of that supply, by reasonable on-chain estimates, somewhere between 15 and 20%, is held in addresses that have not moved in years. Long-term holders, lost wallets, cold storage positions. Functionally, that supply is removed from the tradable float. What remains is the supply that actually clears the market, and that supply is being absorbed continuously by exchange withdrawals into institutional custody at a rate that has accelerated, not slowed, through every period of price weakness in the last 18 months. The institutions are not waiting for green candles. They are accumulating into red ones. This is what the transition from an era of abundance to an era of scarcity looks like. It does not look dramatic. It looks like exchange reserves quietly drifting lower week after week. It looks like custody balances quietly drifting higher. It looks like nothing until the catalyst arrives and the available float is no longer sufficient to meet the demand that has been building behind the regulatory gate. When the Clarity Act passes, when the risk premium that has held institutional allocators on the sidelines finally evaporates, the demand that arrives will not be polite. It will not wait for sellers to set comfortable prices. It will absorb whatever inventory remains at whatever level it has to pay. That is the structural reality of a market that has spent years building demand behind a closed door. When the door opens, the price discovery is violent, not because of speculation, because of arithmetic. There is simply not enough liquid supply to absorb institutional scale allocation at current price levels without significant repricing. The institutions know this. That is why they are positioning now, quietly, into a market that almost no one is paying attention to. The cost of being early is measured in patience. The cost of being late is measured in the price you will pay when patience is no longer an option. The window does not close with a bell. It closes with a quote you will not be able to fill. I know what the last several months have felt like. I know that watching consolidation while the broader market chases narratives elsewhere is psychologically exhausting. I know that every red candle feels like confirmation of the thesis that the smart money has moved on. I know that the silence around XRP feels, at times, like abandonment. Let me reframe what you are actually watching. The silence is the position. The consolidation is the accumulation. The boredom you feel is the precise emotional state that the institutional desks are engineering around you. Markets do not transfer ownership during periods of excitement. They transfer ownership during periods of indifference. Excitement creates exit liquidity. Indifference creates entry. If the price action of the last several months had been a vertical chart and a wave of social media euphoria, you would not be accumulating. You would be selling into strength to someone whose conviction was higher than yours. The fact that the chart is quiet, that the headlines are mixed, that the timeline is dominated by other narratives, that is the environment in which long-term positions are built. Being early always feels like being wrong. It feels exactly like being wrong, right up until the moment the structural reality you have been tracking finally surfaces in the price. And then it feels, retroactively, like the most obvious decision you ever made. The question is not whether the structural thesis is correct. The structural thesis has been correct for years, and every quarter that passes adds further confirmation. The question is whether you will still be holding the position when the structure becomes the price. That is a question about you, not about the market. Here is what this entire moment reduces to. A document was passed across a table in Washington with a word in it that was not supposed to be there. That word, exemption, is the visible signal of an institutional position that has shifted from absolute opposition to negotiated retreat. Behind that signal is a regulatory sequence that locks into place over the next 4 months. Behind that sequence is a supply structure that cannot absorb the demand that arrives when the gate opens. And behind all of it is a math problem that has been waiting for years to be solved by price. The headlines will keep covering the surface. The Senate hearings, the press conferences, the political theater. That is the noise. The signal is in the documents, the on-chain data, the custody flows, and the quiet positioning of the institutions that do not announce their moves until after the moves are made. You are watching the final chapter of a regulatory arc that began 6 years ago. The institutions know how it ends. The infrastructure knows how it ends. The math knows how it ends. The only variable left is who is still holding the position when the ending arrives. If you made it to the end of this briefing, type "crack in the wall" in the comments. I want to see who actually understood the structural significance of what happened in that room and what it means for the position you are holding. If you value this kind of deep structural analysis, subscribe. Share this with someone in your circle who is still reading the headlines instead of reading the documents. I am the calm analyst. The math does not lie. The structure is almost complete. And history does not reward those who were comfortable. It rewards those who were paying attention when the room was quiet.